The world of finance can be an intimidating place for many people. The menu of options is overwhelming, and with so much money on the line, making the right decision is an anxiety-ridden experience for investors. As one of the most potentially lucrative choices, hedge funds have historically been associated with two things: high risk, high return outcomes, and being the black sheep of the finance family. The latter of the two have long frustrated upstanding, successful hedge fund managers who are often asked, does the potential to make a lot of money outweigh the negativity plaguing this investment vehicle?
Like any industry, as we go back in time, the carpetbaggers going to the South during the Civil War, any type of industry that's creating wealth, that's making money, there's always greed. It's a human nature. And out of 9,000 or 10,000 hedge funds in the world that exist today, there have been maybe 10 or 20 different hedge funds where there has been fraudulent activity. That's an extremely small amount. Most businesses are extremely ethical, just like household mutual fund names.
Looking beyond the negative press, there are still some questions looming overhead, such as what exactly goes into a hedge fund portfolio, and are the fees too high? Hedge fund experts are eager to set the record straight.
A hedge fund is a diversified pool of assets, which holds a wide variety of stocks, bonds, futures, options, and is not betting on one or two situations to occur, but betting on many different situations. And through that diversified pool, we believe that we can provide absolute returns for investors. The hedge fund manager is compensated in two forms: a management fee of anywhere from 1% to 2%, and what we call an incentive fee, which is normally 15% to 20%. The management fee is very standard with that of a mutual fund, yet the real difference of hedge funds is the incentive fee. The incentive fee is such that a manager makes money only when a hedge fund is profitable. So a hedge fund is able to share in the profits when they're making more money, and it also incentivizes for the managers like ourselves to generate these profits.
Coupled with the manager's incentive to perform, the point of entry is also in the investor's favor. What used to be an arena for only the ultra-affluent, hedge fund investors still have to meet certain criteria according to law, but are no longer required to put in millions just to get into the fund. In some cases, initial capital can be as little as $50,000, becoming a golden opportunity for private investors.
Any investor is going to get the same return and the same service level, no matter when you put in $50,000 or $50 million. If they are saying, right, we are going to protect your capital in all types of market circumstance, then the vast majority do that. Now, of course, the trick is to make sure you pick a manager that is a good manager, like in any other form of investment.
Investing in hedge funds is not for the weary. As with any investment, risk does exist. But financial experts agree that hedge funds play a vital economic role today, tomorrow, and for generations to come.
I've always felt that hedge funds have performed a really important role in the global capital markets. They're one of the few entities that really goes out to seek risk. Traditionally, investment banks have been performing that function, but over the recent months and I suppose years, that role is being reduced by the banks, and some of that is being forced on them by some of the more recent regulations. So, depending on how that pans out, I think you could see hedge funds taking a more active role in that area.
The reality is that most hedge funds have provided investors substantially better returns than mutual funds or stock ownership. The S&P 500 and Dow Jones had lost roughly 37% back in 2008. The average hedge fund returns were down anywhere from 10 to 15. That shows us that hedge funds outperformed by approximately 20%. That's an enormous return. Hedge funds did exactly what they are supposed to do: preserve investors' capital and either make money or certainly lose far less than the stock market.
I think with hedge funds under such scrutiny in this environment, it's important to have examples of what happens when you take a specialized investment skill, hard work, thoughtful risk management, and a proper alignment of incentives to generate returns that are independent of those otherwise available in the market.
There's no doubt that hedge funds are probably one of the most misunderstood elements in the world of finance. But as we gain a better understanding for this economic instrument, the progress of hedge funds and their investors can continue to move in a positive direction.